Hello, traders. Welcome back once again. In the previous episode, we covered two major reversal chart patterns, triple top and triple bottom. If you haven't watched that video yet, make sure to click the I button on the top right corner before continuing. Now, in this episode, we're moving to the last category of reversal chart patterns, the wedges. A rising wedge is a popular bearish reversal pattern. It starts wide at the bottom and contracts as the price moves upward, forming between two upward sloping trend lines. The key thing to notice here is that the support line rises faster than the resistance line. This tells us that buying momentum is weakening while selling pressure is gradually building up. The contraction in price range from left to right signals a loss of momentum in the current uptrend, making the rising wedge one of the most deceptive patterns for beginners. While it looks like an uptrend continuation, it's actually preparing for a bearish reversal. To confirm a valid rising wedge, the price should touch both the support and resistance lines at least twice. Now here's a surprising fact. A rising wedge can act as both a reversal or continuation pattern, depending on where it forms on the chart. But the main takeaway is, regardless of its position, a rising wedge is always bearish in outcome. You'll often see it either at the end of an uptrend as a bearish reversal or within a downtrend. However, bearish confirmation only comes when the upward sloping support line breaks decisively. Ideally, the volume should decline as prices rise and then expand sharply during the breakdown. That's a classic sign of confirmation. You can also use momentum indicators like RSI or MACD to detect a shift in momentum before the actual breakdown happens. Once the price breaks the support line convincingly, our bias should always be towards selling the breakdown. This pattern usually signals that a sharp move is about to occur, either up or down. But in this case, the break below confirms bearish control. When the rising wedge forms after an uptrend, it represents a bearish reversal pattern. When it forms during a downtrend, it often acts as a continuation of that move. Now that you've learned how to identify the rising wedge, let's move to how to trade it, including the entry, stop loss, and target criteria. Since this is a bearish pattern, we're only interested in short trades once the support trend line breaks. There are two main entry methods. One, enter immediately when the price breaks below the support trend line. You can place your short position at the breakout candle close or slightly below its low. Or, wait for a pullback or retest to the broken trend line, and then enter short when the price starts moving down again. Now, which one is better? There's no perfect answer. If you enter right at the breakout, it could turn into a false break, but if it's genuine, you'll get the best possible entry price. If you wait for a candle close confirmation, you'll reduce the chance of being trapped, but you may enter slightly late if the move is strong. And if you wait for a retest, sometimes the market might never come back to retest, and you'll miss the trade completely. So the best approach is to choose one method and practice it across multiple setups to build consistency. Always confirm the breakout with volume and momentum indicators. A high-volume breakdown shows strong participation, while low-volume moves are more likely to fail. Indicators like RSI or MACD can further confirm momentum weakness before you execute your trade. Now let's focus our attention on the criteria for setting stop losses. How to place your stop loss. When trading the rising wedge pattern, you don't want to set your stop loss at obvious levels like support, resistance, swing highs, or swing lows. And why is that? Because you will get stopped out very easily. Those levels are obvious to you, and they're just as obvious to everyone else in the market, including smart money. So how do you set a proper stop loss? It's very simple. As I've mentioned over and over again, your stop loss must be placed at a level that, if crossed, invalidates your trading setup. In this case, we are trading a rising wedge pattern, and the pattern becomes invalid if the price breaks and closes above the top trendline resistance. So your stop loss must be placed above this resistance level. However, long wicks can still hit your stop loss and then move in the intended direction. So to be extra safe, you need to give your trade some breathing room by placing the stop loss at a distance from the market structure using an indicator like ATR, average true range. So the correct placement is 1 ATR above the most recent swing high level. How to set a target for the rising wedge pattern. There are many ways to lock in profits, but one of the most common approaches is to have a predefined profit target. The target can be measured by taking the distance of the back of the wedge, the widest portion of the pattern from support to resistance, and extending this distance downward from the trend line breakout point. You can also choose to trail your stop loss until the market takes you out. Why is this a better option? Because the rising wedge usually forms in a downtrending market or at the end of an uptrend. In these conditions, there is a high chance the trend will continue strongly, and the only way to ride that move is by trailing your stop loss. A smart way to trail stops is by using moving averages or chandelier stops, and you should only exit when price closes above them. It is even better to use a combination of two methods. Lock partial profits using the price projection target, then trail the remaining position using a stop loss method. This way, you protect your psychology and avoid losing everything in a market reversal. Now moving to the final pattern, the falling wedge. The falling wedge is essentially the opposite of the rising wedge. It forms when the market is consolidating inside two downward sloping support and resistance lines. In this pattern, both trend lines slope downward, but the resistance line drops faster than the support line. The structure begins wide at the top and gradually narrows as price moves lower, creating a cone-shaped formation. As the swing highs and swing lows continue to contract, the price action starts to slow down, which indicates that sellers are losing strength and buyers are quietly stepping in. Unlike symmetrical triangles, which have no clear directional bias, the falling wedge always has a bullish bias because momentum weakens as price moves lower. Just like the rising wedge, the falling wedge can act as both a bullish continuation pattern and a bullish reversal pattern, which is why many traders find it tricky to trade. Now, as we discussed earlier, the falling wedge can sometimes create confusion because it can act as both a continuation and a reversal pattern. The difference depends on where it forms in the market structure. If a falling wedge appears during an uptrend, it's usually a bullish continuation pattern. But if it forms at the end of a downtrend, it becomes a bullish reversal pattern. However, this bullish bias only becomes valid when the price breaks above the downward sloping resistance line with strength. And by strength, I mean a convincing breakout where the volume contracts as the wedge narrows and expands sharply when the breakout happens. This shows that market interest is returning and buyers are taking control again. You can also use momentum indicators like RSI or MACD to confirm this shift in strength before entering the trade. Now let's talk about how to time your entries when trading a falling wedge. There are three main ways you can enter. One, aggressive entry. You can place a buy order just above the downward sloping resistance line. If the breakout is real, you'll enter early, and usually at the best possible price. But remember, this is also the riskiest method because of potential false breakouts. Two, conservative entry. Wait for the candle to break and close above the resistance line. Once it closes, you can take a long entry above the breakout candle's high. This reduces the chance of false signals, but may cause you to enter at a slightly higher price. 3. Retest entry. For experienced traders, another option is to wait for a pullback or retest of the broken resistance line. Once the price pulls back and holds above that level, you can go long on confirmation. This gives a cleaner entry. But keep in mind, the market may not always offer a retest. So, the choice depends on your trading style. Whether you prefer to be aggressive or conservative, whichever method you choose, always confirm the breakout using volume and momentum for stronger reliability. Now let's discuss how to place your stop loss when trading a falling wedge pattern. It doesn't matter whether you entered on the breakout or the pullback. Your stop loss should always be placed at a level that, if hit, invalidates your trade setup. That means if price hits your stop loss, you immediately know your analysis was wrong. And that's exactly how a professional stop loss should work. Don't place your stop loss just below the breakout level or below the resistance line. That's too tight and could easily get triggered by short-term volatility. Instead, look for the most recent swing low inside the wedge. Place your stop loss 1 ATR below that level. This gives the trade breathing space while still keeping your risk controlled. I hope this is clear. Now, how to cash in your winners. One of the most common approaches is to have a predetermined profit target. The target can be measured by taking the width of the top of the wedge, or the widest portion of the wedge, from the support to the resistance level, and then extending this distance upward from the trendline breakout point. You can also decide to trail your stop loss. Now, the trailing stop loss helps you ensure you ride the entire trend. To trail your stop loss in the best possible manner, you can use moving averages or chandelier stops and only exit the trade if the market closes below it. And if you're using moving averages, use the 20, 50, or 200 period moving averages, depending on whether you have a short-term, medium-term, or long-term trade objective. Moreover, it's much better if you use a combination of these two methods so that you can gauge the potential of the move beforehand using the projection method, lock in part of your profits there, and then ride the rest of the position using the trailing stop loss method. This way, you protect your psychology and avoid potential losses due to reversals. Now that wraps up all the major reversal patterns in this series. I hope this video helps you clearly understand the logic behind each pattern. If you found this video helpful, make sure to hit that like button. Also, share it with your friends and fellow traders. Don't forget to subscribe to this channel and turn on the bell icon so you never miss the upcoming episodes. I'll see you guys in the next video, where we'll move on to the neutral or bilateral chart patterns. Till then, trade smart. And remember, it's time to grow.